Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two top-ranked tech stocks to consider buying at the moment, and that is Micron and ALGN Technologies. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into our two top-ranked Zacks stocks, we're going to quickly do a market overview to help understand where these two stocks fit into this broader story and just to give better context for what's going on at the moment. So we know technology stocks have continued their wild selling that we saw through late trading on Friday before some buyers stepped in to help stop some of the bleeding, which was a good sign. So the NASDAQ was down around 10% from its mid-February records through late afternoon trading on Friday, which put it into that correction territory, but it did bounce back in a big way to close the day up about 1.6% last Friday, while the S&P 500 jumped nearly 2%. So it was a good way to end the week after it looked like we were headed for another big down day on Friday. With that in mind, the market was then mixed on Monday morning, with the NASDAQ down about 0.8% through morning trading, while the S&P 500 was up 0.5% and the Dow was up about 1.4% through mid-morning or through morning trading. But things can change pretty quickly amid this recent stretch of volatility. So we saw late last week some Wall Street traders started to worry that the tech-heavy index would be headed down towards its 200-day moving average after it had sunk below its 50-day earlier in the week. The selling continued after Fed Chairman Jerome Powell once again on Thursday committed to the central bank's easy money policies, and Wall Street has increased its bond selling in anticipation of more government spending and the potential of a vaccine-aided economic boom later this year. So the higher yields call into question those elevated tech valuations and make the S&P 500's dividend less appealing. And we know that the last several weeks have seen the major selling coming from a concentrated winner of those big tech companies who have been up huge in the last year. So this is Tesla, Shopify, Apple, all the big names that had been up so big over the last year since those March lows were the ones who have seen a lot of selling. So this correction is most likely just a healthy recalibration and a necessary part of every market, especially when we consider that many of these stocks that have faced all this selling recently were up 100% or more in the last year. So with this in mind, the S&P 500 is down just around 2.5% from its February 12th highs as investors take some of those big gains from tech and maybe rotate them into underperforming areas. And on top of that, despite some of the recent gains in U.S. Treasury yields, they still remain ultra low by historic standards, and the bullish outlook for 2021 remains largely in place, with the earnings outlook continuing to improve. So even if we see some more selling and some volatility, investors might want to consider adding a few names that have been hurt recently amid this broader tech selling, because even if there's more rotation out of tech, long-term tech is still going to be the driver of the market, as it's going to be continuing to drive our lives going forward. So with this in mind, we're going to take a look at these two highly ranked stocks that we're going to talk about today. The first stock we're going to take a look at is Micron, which trades under the ticker MU, and it is one of the largest makers of memory chips on the planet. So its memory chips are key components within PCs and servers, as well as smartphones and solid state drives. The company has been hurt by pricing over the last year, but longer term, the semiconductor space is historically cyclical, and the memory space more heavily is very impacted by pricing. So it's more impacted by these waves. So Micron stock has been on a huge run over the last 5 years, but that's seen the stock face a lot of selling amid pricing pressure within this memory chip space. So therefore, Wall Street often treats Micron more like a commodity, in the sense of it's still a big tech stock going on a massive run, but within that semiconductor space, it trades more in line with its pricing power. So the industry, luckily, has been seeing pricing power return and demand return, and Micron hit its cyclical bottom in the first quarter of last year. The company has since returned to growth in the third quarter of last year. So it still saw its fiscal 2021 revenue slip about 8%, which marked an improvement from 2020's 23% downturn. So it's headed back in the right direction. So if we look back to Q1 of 2021, so it reported those results in January, and that was for the period ended on December 3rd. So the company has not your typical reporting cycle. It also provided some pretty strong guidance at the time back in January. And then on March 3rd, so just recently, the company raised its revenue, gross margin, and earnings per share guidance for the second quarter. And the company continuing seeing better pricing and increased demand for its chips. So with this in mind, the Zacks estimates are now calling for Micron's Q2 revenue to jump 30% to about $6.2 billion, and for its adjusted earnings to climb 98% from 45 cents per share in the year ago period all the way up to 89 cents per share. So for the longer term, we're calling for 20% growth in fiscal 2021 on the top line, and then 60% growth on the bottom line, and then another 24% growth in 2022, and 95% growth in the bottom line. So big top and bottom line growth both this year and next as it returns to growth for Micron after what we said was a bit of a down year. So for 20% growth this year and 24% growth next year, that would be a strong return for growth after the company saw its sales slip 8% last year and 23% the year before that. So a good sign there. And then with that in mind, from that March 3rd positivity, our consensus estimate jumped from 76 cents per share all the way up to 89 cents per share on the back of that positivity. So a big jump there, with our full year estimate up about from $3.89 all the way up to $4.50, and a similar big move in terms of its FY 2022 estimate as well. So this positivity has Micron landing a Zacks ranked number one strong buy at the moment, and this is heading into the release of its Q2 results, which are due out on March 31st. So with this in mind, Micron shares have climbed about 23% in the last 3 months to triple the tech space, and the stock, we should note, began to break out of a rough stretch back in August of 2020. So this past summer is when it really started to break out of that rough stretch we talked about earlier. The stock is also now up about 95% in the past 6 months and 710% in the past 5 years. This sees it top Apple and Amazon and many other giants. The run certainly includes a rough patch, though, and Micron's recent run of positivity has stretched its valuation to its highest level in years, but still, given the memory chips space's commodity-like standing within the chip space, it still trades at a pretty solid discount to the broader industry. So it's trading at about 13.9 times forward 12-month earnings versus the industry's average of about 19.4. And the stock has slipped recently, so it's trading about 9% off its recent records at around $86 per share. And it's resting at neutral levels in terms of RSI at about 50. So in terms of the relative strength index, anything over 70 is often considered overbought, and anything below 30 is considered oversold. So Micron's sitting at that neutral level at the moment. On top of that, 14 of the 21 broker recommendations Zacks has for Micron come in at a strong buy, with 3 more to buy and none below a hold. So you can see that broader analyst positivity going on for Micron. That said, it might be prudent for some to wait for maybe a possible bigger pullback heading into earnings, maybe wait to see how their results actually come in, since they just updated these results beginning of March. But given Micron's longer term outlook within the cyclical space and the fact that it just started to break out over the summer, it could be able to continue its run through the rest of 2021 and maybe beyond, as it's still trading 10% off its early March record. So investors with a longer term horizon might want to consider Micron at the moment, even though it has some possible catalysts, including market-driven catalysts and its own results coming out at the end of the month. So now we're going to move on to a totally different stock, and some might consider it not necessarily that traditional tech name, but it's Align Technologies, which trades in the ticker ALGN, and it is that new-aged dental company that's best known for its Invisalign system. So The tech-focused firm has posted back-to-back strong quarters to end 2020. So it ended the COVID hit year on a high note, and its outlook is really impressive as it grabs more market share and is able to further challenge that traditional orthodontic industry with those old school metal braces. So quickly looking back, the company has been around since the late 90s. It was started in 1997 and went public back in 2001. So it's been a public company for a very long time. And the company designs and manufactures that Invisalign system. So those clear braces. As a little plug, I've actually used these systems. I had braces as a kid, and then I stopped wearing my retainer, and I wanted to just close a little gap that had opened up in my front two teeth, and it was a very simple process. Went to an orthodontist. They recommended Invisalign. It was a simple fix. But so they do all those things from simple fixes to massive undertakings that you'd probably get fixed when you were a younger person in many cases, or later in life. So it was really easy to use, and I think more and more people are clearly going to be seeking these clear options. So its advanced clear aligner system has really shaken up the orthodontic space. People are looking for more viable alternatives to those traditional metal braces. And as I mentioned, they offer similar abilities to straighten teeth and correct various orthodontic issues. The company works hand in hand with dentists and orthodontists who are able to digitally scan a patient's teeth, and then they provide how long you're going to need, what different aligners you're going to need, and how long it's going to take, and then you switch those out every couple weeks or every couple months depending on your plan. So they finalize that plan, provide those custom aligners, and that state-of-the-art printing process is what they do. So along with the aligners, they offer the scanning system as well. They've boasted they've treated over 9.6 million patients, so nearly 10 million patients have used the Invisalign system. They also, as I mentioned, have that intraoral scanner software system that helps them lay out these plans and scan people's teeth. So as I mentioned, the company's success has inspired some other clear aligner companies to enter the market. This includes Candid, Smile Direct Club, which actually went public in 2019, and a few other newer names. And they make similar claims, but there are some key differences. So for instance, Candid is focused pretty much totally at the at-home experience. So this is everything shipped, consultations are done remotely. Meanwhile, Smile Direct gives its customers the options to do that in-person scan, or they can take a mold of their teeth with an at-home kit. So Candid and Smile Direct and some of the other companies are really more of that at-home telemedicine model completely, where Align is focused on working with dentists for those in-person consultations. So this has clearly been something that's still resonating with patients, and maybe customers are not necessarily interested in something that's as a little more complicated than, say, buying clothes or buying shoes and returning them if you don't like it. And it's a pretty big investment. So there are people who still want this in-person consultation, whereas the others are pitching, you don't need to leave your house for anything. But clearly Smile Direct hasn't performed very well since its September 2019 IPO. So maybe Wall Street's seeing that that model's not holding up compared to Align's model. So Align shares have climbed about 140% in the last year. This crushes its highly ranked medical dental supplies industry's 32% climb. This is part of a much larger run that's seen the stock price soar over 630% in the last 5 years. And the recent market pullback has certainly cooled things off, helped set up a better buying opportunity. At around $520 a share, the stock's trading at about 16% below its early February records. The recent downturn has also pushed it below neutral levels in terms of RSI, so it's sitting at about 38. Investors, as we mentioned, anything below 30 is considered that overbought threshold, so it's closing in on that, and it's certainly below neutral levels. Align's valuations still highlight that it's a growth stock. It trades at a premium to its industry, yet at about 12.4 times forward sales. It's trading well below its own highs and at a big discount against other pandemic high flyers like Shopify and things like that. It's also trading at a big discount or a solid discount compared to Teladoc, which is that big, huge telemedicine company that's gone on, bought some other big medicine players, and that's trading at about 15.2 times forward earnings compared to Align's 12.4 times. Forward sales at the moment. So Align's growth has certainly highlighted that its business, as we mentioned, is business model is very, very lucrative, and also it's worth a look because of its growth and its ability to continue to disrupt that traditional space. The company's revenue has climbed by an average of 25% in the last 5 years, and this figure is actually weighed down by just 3% growth in 2020. The recent setbacks happened as dentist's office and orthodontist's office were temporarily closed during the early days of the coronavirus, while people also avoided some non-essential medical treatments. So with this in mind, the company's second quarter revenue of 2020 fell 41%. So that was a big reason for that just 3% growth last year. And then we quickly saw a total regain of momentum. Its Q3 sales were up 21%, and its fourth quarter revenue jumped 28%. So looking ahead, looking back quickly, the company's Q4 results also topped our estimates. The company posted record revenue in terms of volumes from both its Invisalign liners and its scanners. The company also improved its balance sheet and increased its free cash flow during that quarter. And the company executive said it saw a greater adoption from both adults and teenagers, which is a great sign for an orthodontics company, since those are clearly the only two markets, and you want both teenagers who are maybe getting it right when they get their adult teeth, and then adults who are getting it who want to fix things later in life if they never had braces, or just do those simple fixes like I've done myself. So Zacks estimates call for Align's first quarter 2021 revenue to climb 46%, with Q2 projected to skyrocket 140%. Those are against easier to compare periods last year. The company's earnings outlook is even more impressive over this stretch. So overall, its adjusted fiscal 2021 earnings are projected to climb about 74% on the back of 40% stronger revenue. So it's expected to actually pull in $1 billion more in revenue this year to about $3.5 billion. Align is then projected to follow up its expansion this year with 21% higher sales next year and 23% better earnings. So 20% growth on both the top and bottom line in 2022 after what we're calling for is a banner 2021 year as well. So just like with Micron, the company's earnings outlook has improved with its 2021 consensus estimate up about 14% in the last 60 days, and its 2022 figure up about 11%. So this positivity helps it grab a Zacks rank number one, a strong buy at the moment. Meanwhile, 7 of the 11 broker recommendations Zacks has for Align come in as strong buy. Just like with Micron, clearly there could be more selling and volatility in the near term that it's just going on with the market as a whole, and a lot of these stocks that have been on big runs in 2020 and the start of 2021. That said, the stock is trading at a discount compared to its recent highs, and the long-term bull case certainly remains in place for Align because it operates a relatively unique business within that broader medical space that's going to continue to trend in the direction of what Align is offering, which is a similar technology to what has been there in the past, but it's offering it in a new way. And certainly straight teeth aren't going to go out of style in any way. And if Align can continue to make prices that are attractive to more and more people, that maybe more and more people are even able to get their teeth fixed in their teeth straightened. And I know they're also expanding their business far outside of the United States as well. So it's certainly worth considering Align. And as you mentioned, it's certainly worth considering Micron at the moment amid all of the craziness that's going on. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.